All right, let's dive into the powerful and often misunderstood world of futures margin. Now, we're not just going to throw a dry definition at you. Instead, we're going to see exactly how it works and what happens when it goes wrong by following the story of a single trade. So, how is it even possible to control an asset worth a massive $140,000 with just a tiny fraction of that, say 5.5 grand? I mean, it sounds kind of crazy, right? But in the world of futures, this happens every single day. The secret sauce? A powerful concept called leverage. Leverage is what gives futures trading its incredible capital efficiency. It's a massive amplifier for every dollar you put on the line. And that's awesome when you're winning, but man, it cuts just as deep when you're losing. The key that unlocks all this power is something called margin. Now, when you hear the word margin, if you've ever traded stocks, you probably think you know what we're talking about. But hold on. In the futures world, it's a totally different beast. We really need to get this right. Not all margin is created equal. And this is the fundamental difference you have to understand. In stock trading, margin is a loan, plain and simple. You borrow money from your broker and you pay interest on it. But futures margin, nope, it is not a loan. It's what we call a good faith deposit. Think of it like a security deposit the exchange holds onto, just to make sure you can cover any potential losses. It's all about protecting the whole system. There's no borrowing and absolutely no interest. You know, the absolute best way to understand margin is to see it in action. So let's do just that. We're going to follow the journey of two traders who have the exact opposite view on where the market is headed. Okay, so here's our playing field. Our traders are using the super popular E-mini S&P 500 futures contract, or ES for short. The total value of the contract they're controlling, what we call its notional value, is a whopping $140,000. But to open the trade, they only need to put up an initial margin of $5,500. And to keep the trade open, their account has to stay above the maintenance margin of $5,000. These two numbers, initial and maintenance, they are the stars of our story.
So, let's meet our players. We've got Trader A. She's a bull. She thinks the market is going up, so she buys one contract. We call that going long. Then we have Trader B. He's a bear. He thinks the market is about to fall, so he sells one contract, or goes short. And look at this. They both start with the exact same account balance, $5,500, just enough to cover that initial margin.
The trades are on. The stage is set. From here on out, the market is going to decide their fate. Let's see how their profits and losses get tallied up day by day. Now here's a critical concept in futures called marked to market. This isn't just some theoretical paper profit. Oh no. At the end of every single trading day, the exchange settles up all the accounts. Real cash is literally taken from the losers' accounts and put directly into the winners' accounts. It's a daily reckoning for real. So here's a sneak peek of what's coming. Over the next 3 days, the market's going to take our traders on a wild ride. First down, and then a sharp, dramatic reversal back up. And here we go. Day 1, the market falls 5 points. Now, for the ES contract, every single point the market moves is worth $50. So a 5-point drop, you do the math, that's a $250 swing. So for Trader A, our bull, ouch, she loses $250 and her account drops to $5,250. That money gets transferred directly to Trader B, our bear, whose account is now sitting at $5,750. But here's the crucial thing for Trader A. Even though she's down, her balance is still above that $5,000 maintenance margin. So, for now, she's safe. On the second day, the bad news continues for our bull. The market slides another 10 points. That's a $500 move this time. And for one of our traders, it's about to trigger a really critical event. And this is the critical moment. Trader A loses another $500 and her account balance sinks to $4,750. That is below the $5,000 maintenance margin. Red alert. Meanwhile, Trader B is just continuing his winning streak, with his balance now up to a cool $6,250. The moment Trader A's account dropped below that maintenance level, a clock started ticking. She is now facing one of the most stressful events in any trader's life.
She gets the notice, a margin call. It's basically the exchange telling her, hey, your account no longer has enough funds to secure this position against more losses. You need to fix this, and you need to fix it fast.
So what are her options? I mean, she can't just ignore it. If she does, her broker will forcibly close her position, and that loss becomes permanent. So what does she have to do? Well, she has a few choices. She can deposit more money into her account, and notice she has to bring it all the way back up to the initial margin of $5,500, not just back over the maintenance level. Or she could just cut her losses and close the trade. Or she can do nothing and just hope the market turns around quick enough to bring her balance back up on its own. Trader A decides to wait and hope. A pretty risky move. So let's head to the final day of our trade and see how this whole thing resolves. And her gamble pays off. On day 3, the market stages this dramatic reversal and it just roars back up by 20 points. This is a massive $1,000 swing, and this time it's in her favor.
With that $1,000 profit, Trader A's account shoots right up to $5,750. This is well above the initial margin requirement, so her margin call is satisfied. Poof, it's gone. She's back in the clear. Trader B, on the other hand, just gave back a big chunk of his gains.
So if both of our traders close their positions right now, we can see the final result. Trader A started with $5,500 and ends with $5,750, a $250 profit. That's a 4.5% return on her capital. And Trader B takes the corresponding 4.5% loss. And this, right here, this is the key takeaway. The underlying S&P 500 only moved a tiny fraction of a percent over these 3 days. But thanks to the power of leverage, that tiny move translated into a significant 4.5% gain or loss for our traders. Understanding how margin works is absolutely essential to managing this amplified risk and reward.
Which brings us right to our final question. Is leverage a powerful tool for capital efficiency, or is it a dangerous trap for the unwary? As our trader's journey just showed us, the answer is, well, it's both. And the difference lies in understanding and, more importantly, respecting the rules of margin.